The Minister for Finance, Michael Noonan, introduced a number of new measures for Budget 2012. The Minister indicated that his aim was to regain control over Ireland's fiscal and economic policies, to grow the economy again and to get people back to work. On personal tax, the Minister has made no changes to the personal tax rates and bands. However, he did amend the universal social charge from January 1st, 2012. The universal social charge exemption limits have been increased from €4,004 to €10,036 to help the low-paid and part-time workers. In respect of VAT, it was widely expected the Minister would increase the standard rate while leaving the reduced rates remaining the same. The standard rate of VAT was increased from 21% to 23%. The reduced rates have remained unchanged for 2012. Most children's clothes, food and oral medicines stay at 0% VAT rate. The Minister today announced an increase in the rates charged for motor tax on both new and used cars. They are as follows. Old cars. The cost of taxing a vehicle across all 7 bands have been increased. New cars have been increased by the amounts shown here. Now let's look in more detail at some of the incentives Budget 2012 has introduced to Irish business. The foreign earnings deduction have been announced to support export companies seeking to expand into emerging markets. Brazil, Russia, India, China and South Africa, the so-called BRIC countries. Research and development has been further incentivised with the first 100,000 of R&D expenditure for companies to be allowed on a volume basis for the purpose of the R&D tax credit. The Special Assignee Relief Programme is to be introduced to help companies hire key individuals. This, it is hoped, will allow multinational and indigenous companies to attract key people to Ireland so as to create more jobs and to facilitate the development and expansion of businesses in Ireland. In keeping with the introduction of carbon taxes in previous budgets, the Minister has increased the current carbon tax by €5 per tonne. This will affect you in the following ways. Now to pensions. Budget 2012 has increased the rate of notional distribution on the highest value approved retirement funds and similar products to 6%. There is also an increase in the rate of tax on the transfer of an ARF on death to a child over 21 from 20% to 30%. Budget 2012 has also introduced a number of measures to help the struggling property market. The Minister increased the rate of mortgage interest relief to 30% for first-time buyers who took out their mortgage between 2004 and 2008. For those who wish to buy a home in 2012, first-time buyers will get mortgage interest relief at a rate of 25% rather than 15% proposed by the previous government. Non-first-time buyers will benefit from relief at 15% instead of the reduced rate of 10% proposed previously. There was also the introduction of a capital gains tax incentive for property purchased between the 7th of December 2011 and the end of 2013. Stamp duty on commercial property is to be reduced to 2%, while residential property stamp duty remains unchanged. There has been a more gradual phasing out of legacy property allowances and reliefs. However, a 5% surcharge on investors with gross incomes exceeding $100,000 has been introduced. The Minister has made further changes to other tax categories. He has raised both capital gains tax and capital acquisitions tax from 25% to 30%. He has also reduced the Group A tax-free threshold to $250,000 for CAT purposes. Deposit interest retention tax, DIRT, is being introduced from 27% to 30%. This video presentation is a summary of the contents of Budget 2012. For further information on how this budget affects you and your business, please consult your business advisor.